Candlestick Zen. Always control your losses. If you don't limit losses of your trades, you risk losing everything with every trade. Are you really willing to lose all your money in a single trade? That is gambling, not trading. Trading is about performance of thousands of trades, not one or two. Performance of your trading will depend on how you control your losses. Always set up a stop loss for every trade you make. Stop loss can be predetermined or it can be triggered by some condition. Example of a predetermined stop loss would be setting it to some specific price. At the time of opening your trade, you set up your stop loss according to your strategy. This is the easiest way of setting up stop loss. If you're a more experienced trader, you can choose not to set up stop loss, but to wait for an event. In this case, your stop loss will be triggered by a specific event, for example, price crossing the moving average. Depending on the condition, you might want to also have a fixed stop loss as well. You can wait for a condition to trigger your stop loss, but only up to a certain price. This combination of predetermined and conditional stop loss can help when market moves very fast. You can set up your stop loss in 3 different ways: market order, automation, and the mental stop loss. The easiest way is to simply set up your stop loss when opening your trade. This will create market order that will be executed if the price reaches the stop loss value. If you do not set up stop loss immediately, you can still update your trade after it's opened. This will also create a market order that will wait to be executed. The second way is by using automation software. You can have your code taking care of your trades, closing them when needed. If you use software, you can have more complex stop loss exit strategies. The third option is that you simply memorize where your stop loss is for each trade. Beware, this can be dangerous if you're not disciplined. Having a lack of self-control and a mental stop loss could easily backfire on you. If you do choose this approach, train your mind. No matter which type of stop loss you choose and how it is executed, stick to it. Think about the long-term performance, not about the current trade. In the long run, any individual loss does not matter. But it will matter if your lack of self-control makes you keep losing positions open every time. Do not change your stop loss under any circumstance, unless your strategy says so. The biggest mistake beginners make is moving stop loss away when it is about to be executed. This happens because they become emotional. They believe that this one trade is more important than it is. It is not important. Take the loss if your strategy says so. Trust your strategy. If after a while you change your mind about the strategy, change it. But as long as you use the strategy, stick to it. This is how you will develop your confidence. And only if you are confident, you can stay calm while trading. There is no other way to become confident. The only way is to test your strategy and trade a lot with it. Then you will have the results showing you that it is okay, that you do not have to fear anything. Yes, sometimes if you don't set stop loss, you will avoid losing money and you will earn a bit. But if you repeat this enough times, you will lose everything. Not using stop loss on few trades will not make you rich, but it will make you develop a bad habit and it will make your strategy unprofitable. You can have different stop losses depending on market conditions, but always test your stop loss under the same conditions before you create a rule. Some brokers have stop level and freeze level requirements. These are minimum distance requirements between the price and specific order price level. They affect more than just stop loss, but since the topic is stop loss, I will explain only this part. If a broker has a stop level, it means that you have to put some distance between stop loss and the price. If you're buying, your stop loss size in points has to be lesser than or equal to bid price minus stop loss. If you're selling, your stop loss size in points has to be lesser than or equal to stop loss minus ask price. Note that when I say stop loss, I mean stop loss as a price level, and when I say stop loss size in points, I speak about the absolute size in smallest units. Smallest unit size will depend on broker and the asset you're trading. Typically, in Forex, currency pairs will have 4 or 5 decimals. Smallest unit of a 4-decimal pair is called pip, and it is 1/100 of a cent. Smallest unit of a 5-decimal pair is usually called pipette, and it is 1/100 of a cent. But you will sometimes hear people calling a pipette a pip. Some other pairs in Forex will have 2 or 3 decimals. For example, USD JPY. That's US dollar against Japanese yen. In this case, 1 pip is 1/100 of a yen or 1,000th of a yen for 2 or 3 decimals respectively. Those are the most common unit sizes, but you will encounter others as well. Just be careful to always use the correct unit size when calculating your stop loss. I already mentioned that you shouldn't change your stop loss unless your strategy says so. But in case your strategy needs you to change the stop loss of an open trade, you should be aware of your broker's freeze levels. Freeze level will prevent you from changing your stop loss if the price is too close to it. Like I said before, freeze level is not only about stop loss, but we are speaking about stop loss now. And it is time to stop talking about it, at least for now. You got the idea. Use the stop loss for your own good. Do not focus on the effect that stop loss has on any particular trade. Instead, focus on the long-term benefits of limiting your losses. Do not try to save a couple of trades just to lose all your money. It is better to lose few trades now and then and make a fortune in the long term. Candlestick Zen.